Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, it's the last call for one of our most popular workshops, the Smart Social Security Blueprint. Our go-to guy on Social Security, Sean Swanson, will be presenting. It's Wednesday night, March 22nd, 6:30 p.m., right here at the Midwest Learning Center at Retire Smart, 402-369-7777. Could you give people a quick synopsis of what they can expect?
So Sean does a great job of teaching this course. You're going to understand the basics of when you can draw Social Security, what the ages are, and what the benefits are of potentially waiting, so that you can understand based on your personal situation, maybe when you should not potentially draw if you haven't yet drawn. Also, he goes through some of the components of benefits that people may not realize are there: spousal benefits, widow and widower's benefits, etc. And he's actually going to, I think, even cover a little bit of. There's some bipartisan chatter finally of changing it again. Again, it needs to be done. We'll talk about it later in the show. But Social Security has not had any actuarial changes since 1983, and that was the only time we ever adjusted it since the original inception way back in 1935. So there may be changes coming, and we'll just talk about what that would mean for people as well. And then what's really important is he then talks about not only how to maximize Social Security, Chip, but how we say optimize it, so you understand how it will be taxed and how that decision is critically important. You understand the tax consequences if you have other sources of income, etc.
402-369-7777. Don't wait, register now. This one fills up. Smart Social Security Blueprint. Wednesday night, March 22nd, 6:30 p.m., right here at the Midwest Learning Center at Retire Smart. 402-369-7777. All right, David, this is a news story like we haven't seen in a long time. The Silicon Valley Bank failure. The New York Post couldn't help noting that CNBC's Jim Cramer, again, got one wrong. He was advocating that people buy this stock. He wasn't alone, though, but maybe don't get your advice, your financial advice, from a celebrity advisor. Maybe that's what we take from that.
Well, yeah, I mean, he just, and let's be clear, listen, Jim Cramer's had a long career. He wouldn't be where he is if he didn't have some sort of success, but it is sad because he goes on to his show like a talking head, and he pitches stocks to people that aren't his clients, and to me that's a problem, number one. And obviously they put all the disclosures on the screen. As you never hear me tell you, hey, buy this stock on this show. That's not what we do, Chip. But unfortunately, yeah, he got this one wrong in a major way, and he's got a history of doing this, sometimes just kind of hitting that bullhorn at the wrong time. I will have you know, he recommended you buy Bear Stearns about a week before it went out of business.
Ouch.
15 years ago. So,
Well, people are comparing what just happened to that. David, in my mind's eye, I'm seeing It's a Wonderful Life and the Bailey savings and loan, the run on the banks and so forth, that people are using language that we haven't used since the Great Depression. There's a barrage of news out there. CNBC has a headline: Moody's cuts outlook on U.S. banking system to negative, citing rapidly deteriorating operating environment. Gateway Pundit has a story: Biden crisis. Moody's downgrades banking segment to negative. Assets in U.S. banks are $2 trillion less than their balances. And the lead sentence of the story is, Biden couldn't have done a better job destroying the U.S. economy if he tried. You sent me a chart from Zero Hedge. David, I put all that on the table and let you have at it.
all right, so let's start with SVB, Silicon Valley Bank. All right, so one of three banks that went under in a week's period, in less than a week's time, and actually about 4 days. And so what happened is exactly the proverbial run on the bank. So when you go to put your money in the bank, they don't just stick it in the vault, right? It's not sitting in the safe overnight where the bank robber and the old, black and whites would go in the movies, would go in there and rob the bank and get the cash. The bank wouldn't make any money doing that. So the bank, to make money, has to keep what we call capital reserves. That's going to be around 8 to 10 cents on the dollar. Okay, so in other words, if you go put $100,000 in the bank, they only put about $10,000 roughly in the vault, so to speak. Right? They keep that in cash reserves. The other 90,000, they are going to invest in a myriad of ways. They're either going to lend it to you as the consumer on your credit cards and your mortgages and your cars, and you're going to pay them a higher interest rate than they're paying the depositor, right? And they make what's called a net margin spread. Once their reserves get big enough and they believe that they have a little bit longer time before anybody would ask for those deposits, they're going to stretch those investments into longer denominated investments. So as the balance sheet gets bigger and bigger, one of my favorite investments, Chip, we talk about all the time, is real estate, right? So it would behoove the bank, they would be smart if real estate is a good total return asset, has tax advantages, all the things we talk about, to invest in real estate. And certainly they do. You can't drive around any city. Who has the most buildings on the corners of red lights, right? It's banks, right? Because that real estate appreciates in value. It's not just that they set up shop to operate the branch. The real estate itself is a core investment for the bank. They're going to invest in all kinds of things. They primarily invest in bonds, typically U.S. Treasuries, the safest bonds out there. Now, there's many denominations, Chip, of these. You can buy 4 weeks, 6 weeks. Well, unfortunately, they went long on the duration of the bonds they bought with all the capital they've had in the last couple of years because they're getting all this free money from the Fed. And again, the Fed is partially to blame, but it's truly the risk management of the bank that is to blame. And I'll give you some shocking information on that in a moment. Who is their chief administrative officer? Do you know his previous job was the chief administrative officer of Lehman Brothers?
Oh my goodness!
Yeah, another failed bank that collapsed to.
There's a pattern
15
developing
years.
here.
Yeah. So what happened is they have bonds that are way out on duration, and the Fed keeps raising interest rates up. And as interest rates go up, bond prices go down. In particular, the longer the maturity, the more that price is going to go down. Well, now if I go to the window and say, Chip, I need to pull my $30 million out of your bank, and this bank in particular had a lot of venture capitalist money, a lot of tech money out in Silicon Valley, and so they would put the cash in there because they're getting paid a decent rate while they're sitting on it, and then they would pull it out to invest in a startup, invest in real estate, whatever it is. Well, the bank's got to go sell these bonds off, and so when the people started coming to the window for cash this year, about the time Kramer was touting the stock north of $320, basically they had to sell the bonds at a loss because the Fed didn't pivot. They didn't stop. And again, they should have actually looked at the data like we do. I've told you the Fed was not done, right? We talked about how it wasn't that hard to look at it. And so they miscalculated, and now when they go to the window, they had to sell at a loss. So what they did is they went out and said, okay, we had to sell a bunch of stuff at a loss. They took about a $2 billion loss selling bonds to make sure they had cash. And then more people came. Well, hey, if they have to sell stuff, I might need to get my... And the proverbial run on the bank happened very quickly.
So that disclosure actually was the spark that ignited the
Correct. They thought
fire.
they could go to their investors and do what we call a secondary offer, sell stock, if you will, in the bank to raise the capital. And they said, no, I'll just take my deposits, please. And we had $42 billion worth of requests in one day. This is only a $200 billion bank. So like I told you,
the bank is humming.
They usually only keep 10 cents on the dollar right in the reserves, and 25% was called out in
George
one day.
Bailey trying to hold off the crowd at the window at the Bailey Savings and Loan. Now, hold on. If everybody comes all at once, we're out. Just take a little bit. But they weren't willing to.
No, and so now the problem is that systemic risk, if you want to call it, that's why the Fed backstop them, goes to the next bank and the next bank. And so the regional banks, there were several of them that got hammered. First Republic, PacWest, you can look at them. Some of these stocks were down over 60, 70% very quickly. But you had Signature Bank fail on Sunday, right? 2 days after SVB Bank failed. Now, here's where it gets interesting. Who's on the board of Signature Bank?
Oh, no.
Barney Frank.
Oh, okay.
Who wrote the Dodd-Frank legislation
right
governing
the
banks.
last round of,
now, he came out and the left
and
is all over Twitter saying, oh, this is Trump's fault. He deregulated these smaller banks.
Yeah.
Barney Frank is quoted. It is not Trump's fault. So he actually
good
put
for him.
that out there.
Okay.
This is has nothing to do with that. But anyway, the problem is it's risk management at the banks. And unfortunately, Chip, if they would just let 3 or 4 of these banks fail, yes, there'd be fallout. Yes, there'd be some turmoil. Some companies would lose money. But that's how the free market works. And then you're going to really think, where am I going to put my money? Am I just going to go blindly in there because this is the bank everybody says they use? Or are you going to do your due diligence and invest your money wisely? So it's
okay, now see, my populist conservative Tea Party DNA starts to get inflamed and agitated at this point because you mentioned Bear Stearns, Lehman Brothers, and others. And so the last time something like this happened, the bad actors were bailed out. So what's going on now? Because the FDIC covers up to what, 250,000
per depositor.
But are bad actors once again being bailed out here?
Yes,
that's what worries me.
100%. 100%. Now here's all right. So here's the thing: SVB Silicon Valley Bank was sold to HSBC, okay, another bank that doesn't have the greatest financials, by the way, and for a pound a share, or basically the equivalent of about $1 a share, right? I want to take you back in time, September 15th, 2008. The markets were down over 30%, right? The markets, the financial crisis was kind of in the midst of happening, and we had Bear Stearns disappear the week before, went under. Lehman Brothers was about to, and so the Fed stepped in with the backstop and try and show everybody everything's fine, and they negotiated the sale, just like HSBC just bought SVB.
Mm-hmm.
J.P. Morgan purchased Lehman Brothers for $2 a share on September 15th, 2008. The S&P closed that day at 1192. March 9th, 5 months later, the S&P was at 667, a 50% drop from when the Fed said everything is fine. Now, I'm not trying to scare people or give any great prognostications, but this ain't over, all right? And just this week, Credit Suisse, there's a run on Credit Suisse happening now, a very large Swiss bank, one of the largest in the world, because, again, they have stinky balance sheets. And you mentioned earlier, some of these banks have these problems. Now, this won't get as quickly as bad as 2008, at least I don't think, because in 2008, we still had what we call mark-to-market accounting. So if you have a bond, Chip, let's say you have $100 million of bonds face value, but because interest rates move, they're only worth, just call it 90 million instead of the 100 million, right? If you don't need to sell them, we're not going to make you price them below the 90 million. They're worth 90 million, right? But now, if Bank B over here, another bank next to you, is in trouble and has to sell their 90 million current value, even though it's 100 million par, they have to sell the 90 million bonds, but they sell it at a discount for 80 million because they just need the cash. They have to take the loss to survive.
Yeah.
In 2008, we would have made you go back. Now you got to price yours at 80 million tomorrow. And now you're insolvent, and we spiraled the banks out of control with idiocracy rules.
Yeah,
We
okay.
fixed that, so that won't happen here. But there are going to be losers, and we shouldn't backstop. We should let the losses fall and we'll let the carnage happen, and it'll be over much faster. But unfortunately, that's not. So we're going to stretch this out for another year. We'll be talking about this in a year. It's going to get ugly, and that's the reality. So I wish I had better news, but again, if you have less than $250,000 in your bank, do not panic. You don't need to go run on the bank. There's never been a dollar lost in an insured account anywhere in the FDIC insured system. And you may use a credit union, and they're not FDIC. They have their own version of it. The same thing. They're backstopped to the same limits. So don't get panicked. But should you have cash on hand? Oh, you should always have some cash on hand, because that's a question we got this week. Should I have some cash? Yes. In fact, my wife likes to have cash like in the safe, you know what I mean? A certain amount. So
I thought it was under the mattress.
Anyway,
Melissa's mattress money.
Melissa's mattress money. There's a combination lock. There's a safe under the mattress.
Well, don't go mattress on. Don't go to the mattresses, as they say in the Godfather movies. I say this every week, David, but boy, now more than ever, we are in unprecedented. Well, there are some precedents. They're not the kind of precedents that we want to revisit. 2008, the Great Depression. Don't panic, though. Don't panic. If you haven't already done so, come see us. Get a report card. It's complimentary. It's a complimentary review of your entire financial situation. Maybe you're in good shape. Maybe with what's happening now, you need to make a few changes. Well, now's the time to find out. 402-369-7777. Complimentary report card. No charge, no obligation. 402-369-7777. Up next, Retire Smart wants to be your one-stop shop for all your financial matters. That includes insurance. Stay tuned for another visit with Michael Luna of Smart Protection. Next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. The R in a SMART plan stands for risk management. It is vital that you are properly insured so that your retirement nest egg is not wiped out by an unexpected damage claim against you. We have someone on our Retire Smart team specifically dedicated to minimizing your insurance costs while maximizing your insurance protection. David, please introduce our special guest.
Thank you, Chip. Yeah, welcoming back into the studio, we have our favorite protection friend, Mr. Michael Luna. Mike, how you doing?
Good. Thanks for having me back.
Absolutely. Glad you could take some time to join us this week. So for those of you listening, Mike has been on the show many times before. He runs our property and casualty division, among other things, his responsibilities here. We call that smart protection. And so we're always trying to help our clients understand how to protect what they have. And this includes understanding the liabilities and risks that you have in your home, your auto, umbrella policies, which you probably should have, explaining all that. But really just want to kind of dial in on inflation's still hot. We just had CPI come in this past week at 6%. PPI actually went down, so there's some good news that inflation certainly has peaked, but it's still there. It's still ugly. But when people are getting the renewals right now, you were telling me that there's some sticker shock for a lot of folks right now.
Yeah, so we've talked about it before, like you said, but inflation drives everything, including your insurance premiums, due to the cost of building materials, labor, parts, so on and so forth. But those premiums don't typically decline with inflation. They typically continue to go up or stay the same at least.
Right. And so right now, because lumber, 9 months to a year ago was all time highs, it's come off of that. But the data sets the insurance company are using is about a year old. So that's the lumber prices, if you will, that their calculators and computers are punching out. Hey, if we got to rebuild your home, this is how much we're going to have to pay in lumber, et cetera, for trusses and all that kind of stuff. And so that's driving the cost of these premiums up on a lot of policies, right?
That and the companies are making up for lost premium from claims. And claims a year ago cost more than they do now. For
Oh,
instance,
that's a great point
because
there.
of building materials.
So obviously there's a percentage of people that are going to have claims every year. They actuarially factor this in, but those claims they're paying more out of pocket. So not only just the actuarial numbers that if yours were to burn down or have a hailstorm or whatever it is, you have some kind of peril, but the ones they actually paid out, they had to pay out more than they projected. Now they got to get their reserves built back up. So
Exactly.
how do they do that? Well, they just slide a little bit more dollar into the premium, right? So what can people do if they get this sticker shock, or what should they do?
Shop your policies. That's the first thing I would suggest. And it's, obviously we're an independent insurance agency, so we work with multiple companies, quote unquote, a broker. But shop it out. Make sure you're not overpaying. Insurance, unfortunately, it's a commodity.
So he said something really important right there. So basically, because Mike is independent, he's got, I don't know, up probably a couple dozen carriers that he can go reach in and run prices on. But if you're with what we call a captive company, and so this is typically going to be like the good hands people, or like a good neighbor, somebody's there, those type of companies, right? These there's two big ones obviously, but they are captive, and so their agents are great intentions, what have you, but they can only kind of bring one product to the game, if so to speak, and so you may get limited if you're staying with one of those type of insurers. But what inside the policy? So number one, shop, and I think Mike, you can help him with that, right?
Yeah,
All right.
absolutely.
All right. So we can help you with that if you need somebody to shop. But number two, inside the policy itself, are there certain coverages that are kind of the red flags or things that stick out that you notice? Maybe people are paying for coverage they don't need, and also not having coverage you do need. And I know this from he really got me to understand this. Well, for the last couple of years, I think I'm sadly becoming his best client. I've got several rental properties and things like that, but Mike is really well versed at this stuff, showing you, hey, you're paying for coverage over here you probably really don't need, but I would suggest you up your amount of coverage on this line item. Can you just talk about where the easier low-hanging fruit is for people to just maybe when they're looking in there to understand their coverages?
There's a lot of endorsements that you can add, a lot of riders you can put on a policy to tailor fit it to your specific needs. And I'll tell you, the claims I see the most are from those endorsements and riders. And if you don't have it, the company pays very limited amounts, if any at all. So that's where I see the most claims, and the people that are shocked when they realize I don't have that coverage. I pay thousands of dollars a year, and have been for how many number of years, and they're
maybe
not covered.
having the right coverage inside of that rider endorsement might have been $12 more or something,
Yeah.
but would have covered. And I mean, there's things like a lot of people don't think about, like you accumulate a lot of jewelry. I'm not a big jewelry guy, but I do have a few nice watches. I love really nice watches, and those to me are almost an investment. The ones I'm talking about go up in value, but I don't wear a watch every day anymore, and very few people do. I mean, let's face it, you've got the clock, but I still love them. But they are expensive, and I mean, I have one of them that is really expensive, and if that were to disappear or something, that would my normal homeowners would not cover that, so I have to have a rider, which you have put on there, and it's quite expensive. And of course, I'm like, you want to pay extra? How much? But it's the right coverage for you to give to me. And so, but understanding that's really, really important. What if you have like a baseball card collection or memorabilia, sports memorabilia, or even like a classic car, right?
Yeah.
I have an old classic car that's yet to be restored. Someday we'll get around to it. But things like that are that's a different type of insurance, right?
Yeah, and it's specialized insurance, and if, for instance, your classic car, if you don't have the correct amount listed on it, you're only going to get paid so much out, and people don't even realize that. They think, oh, it's worth so and so on the market. Well, the insurance company doesn't see it that way unless you you know are transparent and you give them all the information, and they can get you the right coverage.
Unfortunately, I had a client who loves some classic cars. Has about a 60-year-old vet, beautiful car that somebody hit, and thank goodness he did have the right insurance. But it doesn't matter. Now it's a damaged car, so it will never be worth the same mint price, if you will. But he was at least, I had the right coverage. I paid a lot for it, but it just, those are important things. I had somebody else who had a classic car who went 43 years with the same set of tires. Actually, we're just in a review this week. 43 years, they got the same set of tires out of they finally got new, and they're like, wow, this thing rides pretty good with new tires. I would think so, But anyway, so anyway, you just don't know what you don't know. I say it all the time, but when it comes to the world of insurance, it's specific, and I don't even know it when it comes into all these coverages, and Mike does a phenomenal job of explaining it. In fact, if you would like to learn how he explains this, you actually have a class coming up, right? We call that kind of the Smart Insurance Workshop.
Yep. It's coming up on Tuesday, March 28th. 2 sessions, 10 a.m. and 6:30 at night, so we can hopefully accommodate as many people as possible. But we'll go over your 3 basic main policies: home, auto, umbrella, and we'll touch on a few other areas as well. But really, just trying to educate people on their policies and what your policy can do for you.
So how to have the right amount of protection for what you actually have, maybe eliminate protections that are wasteful or not needed, and then understand like the umbrellas. You touched on that is really important. I can't stress enough, folks. Once you have a net worth of just about $500,000 or more, house equity, things and other, you need to have an umbrella coverage that covers you over and above what maybe your auto policy is covering, and then having the right endorsements listed on that umbrella. I actually had a very high net worth client that had an umbrella and thought he was covered and didn't have anything listed on the umbrella except just him and his wife and his cars, and so would not have been covered had he had a claim.
That, and just little things. A lot of people don't realize when they have a separate entity and they now transfer rental properties into it, that your personal umbrella doesn't cover those things, and the general public just doesn't realize it, and they sometimes get caught with their pants down.
So really important to make sure you understand that. So again, those classes are coming up here March 28th. There's a 10 a.m. class, and then for those that can't make it during the day, there is a 6:30 p.m. class right here at the Midwest Learning Center. Now, speaking of teaching, you actually were taught this past week, right? With you were able to you have Mike is part of another business that helps clients protect their assets from going, unfortunately, maybe to the nursing home, right? And so you were actually able to teach for a couple of dozen of folks that lead or work and run several of the assisted living facilities in our area, right?
Yep, correct. People seem to think that even though when a loved one enters the nursing home, that they continue to be told you have to spend all your assets down in order to qualify for Medicaid state benefits.
Right.
And that's just not true. And so I was able to speak in front of a couple dozen executive directors at facilities all throughout Omaha and educate them on different ways to help their clients and their residents. And because let's face it, when somebody goes into a facility for the first time and they show them the cost, they get sticker shock.
Yeah, it's not cheap.
And they told me that 60 to 70% of the people that actually visit never come back again. They never hear from them again because they try to make it work at home.
Right.
And that's sometimes not the best.
No, and then if you have to have in-home care, that starts to add up as well. But so real quick here, folks, there's what's called a 5-year look back, and you have to spend down, unfortunately, federally, to basically got $2,000 left to your name. And there's certain things you can exempt. You can exempt a vehicle and your home, et cetera, but primary residence. But you have to spend your IRAs down. Doesn't matter. You have to spend your 401ks down. All this all the way down to basically $2,000 before you're going to get the government to help. That does not have to be the case. And even if it's tomorrow, you could already be in the home, Mike can show you solutions where you can actually protect a portion, sometimes greater than half of the assets from that spend down, with understanding how to do Medicaid planning. And we have an entity called Senior Asset Solutions that Mike also heads up, and he's actually been able to help several of our clients understand this and protect assets. So if you'd like any information on that, or you'd like to get registered for the Smart Insurance class, we're out of time for this segment. Give us a call at 402-369-7777. Again, 402-369-7777. Just let us know you'd like to get registered for the Smart Insurance Workshop, or you'd like to get some further information on how to do the Medicaid planning. Mike, thank you so much for stopping by.
Thank you.
All right, Chip, what is up next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, we're still cycling through questions from our State of the Market event. We had a lot of attendees with a lot of questions, and here's one about cyber security. How safe are investments against cyber attacks?
So, cyber attacks are very real, and they're going to continue. And it's almost the adage of when information or data gets stolen, it's not a question of if it will happen, but unfortunately, probably when. If you have your information at any of the major retailers or major credit card companies, they've already had breaches in the last 10 years. And Wells Fargo had one of the biggest settlements in history years ago. But that's going to happen. So all you can do is be diligent and protect your information as best you can. But some simple basics is, like, we use a password system here at work. So we have a lot of information stored in various places on the cloud, if you will, very secure. But you can use things called two-factor authentication. So before you log in with just a password, maybe you get a text on your phone with a new code to let you into certain softwares or where you store your data. But I also encourage you, do not use the same password everywhere. And this is very common. People have their very, their dog's name in the year they got married or something. And that's not too difficult for cybersecurity to hack. So what you want to do is be diligent and do as best you can. Like we also, because if it were to happen, we've never had the breach here, but if it happened, we have cyber insurance for that. But it's an ongoing threat. In fact, we have not one but two external IT companies we pay and consult with on top of the insurance and what have you to help stay us on top. In fact, my brother Lou's been really instrumental in helping us implement some new stuff to just protect clients' data. But that's an ongoing reality. And you just need to be diligent. And so if you got your passwords written down on your desk drawer, you open it up and they're all right there. They aren't really passwords, right? So just be diligent and think about it. But the reality is it's something that you're going to have to monitor and stay on top of it and pay attention.
Next question, David, is about inflation and precious metals. In times of rising inflation, why aren't precious metals playing a bigger role in portfolios?
So gold has actually caught a bid here recently, and precious metals will go up if the dollar goes down. But like in the last year, we did not have a very big exposure to gold for clients. For the main reason is the dollar kept getting stronger. And as the Fed is raising rates, and we're getting to the end of that cycle now, so gold may play a bigger portion in portfolios, at least the way we look at them. But you have to understand is gold, precious metals are just a hedge, Chip. They just hedge against currency, and what currency matters. So you can buy gold here. Most people are going to buy it in what we call dollar terms. They're going to price it in dollars per ounce. But if you were in Europe, you'd buy it in euro terms. You can buy it in yen terms. You can buy it in rubles, et cetera. So it's a hedge on the value of the currency, because if you think the currency is worth less, has less buying power, that means that the gold price would go up against that currency. So it's a hedge. And so gold lost money last year and went down most of the year because the dollar kept getting stronger. And we're not quite to the end, or the dollar has not rolled over and started to get weaker where gold would make sense. But and again, if you're going to own gold, we like you to own physical gold, but not inside your retirement accounts. We'd prefer people that can afford it to own physical gold in a safe or storage facility. But you need to know and understand there's commercials everywhere right now.
That's just what I was going to say. You've mentioned it on the air. In your 2+ decades as a financial advisor, there have been some sad stories of people who put it all in gold, and then they get walloped.
Gold pays no no dividend. Gold has no earnings, right? And unfortunately, if you own like a physical gold IRA, these are been bombarded on the airways right now by unlicensed professionals. They're not securities professionals that are selling it. They don't have to be. They're just selling a commodity. There's storage fees. There's doc fees. There's self-directed IRA fees that go with this. And then people sometimes make the mistake. We've talked about some of those cases on the air, Chip. You touch that gold, you're like, they ship you a safe, and this is your IRA, and your gold's in there. You open it, you put your finger on that gold, you've made the entire account taxable. And that's anyway. There's just so many missteps there. But yes, gold and commodities in general are an important part, but commodities in general right now are going down because we're in a recessionary environment, and commodities soften. Gold and silver, the precious metals, will get stronger if and when the dollar gets weaker.
Well, speaking of a recessionary environment, the next question is about tight money and defaults. With the money supply shrinking, won't there be a large number of defaults as folks and companies can't roll their debt? What will this do to the economy?
Well, we would love to have seen some defaults happen in the last week or so, as we talked about. But unfortunately, right now, if you're in the banking industry, apparently you can't fail. The unprecedented move here by the government to say we're backstopping all deposits, and that's a little scary. Where are they going to get that money? Oh, but no taxpayer dollars are going to be used. I mean, and they say it with a straight face.
That's
Chip.
fantasy.
Yes,
Yeah.
it's absolute fantasy.
Yeah.
And the problem is it's going to make inflation even a bigger problem down the road for us. So yes, we are tightening money, and it's going to tighten the economy, and companies will default and companies will get in trouble, but that's how free markets work. And so what can you do is you protect yourself. You take risk off in that environment, as we've done for our clients now 5 times in the last 12 months. We've taken specific action to de-lever or de-risk, if you will, portfolios from. Now, no one knows. We're always going to be invested to some degree. You can't just go stick your money, as I joke about it, Melissa's mattress money under the mattress. But there are times when we see higher risks than others, and this is one of those times. So I cannot stress people enough. If you would like to get just a complimentary risk analysis, I'd be happy to provide that on what you own, what the volatility is, and what you may expect if we were to go through a significant downturn in the economy. And we do believe a downturn is coming. I don't know how deep it is. I don't have a crystal ball, of course. So take heed and take action.
So nature, as it applies to financial markets, nature is going to run its course, but we have multiple strategies to deal with whatever scenarios nature presents us.
Look, it's just like COVID, right? It had to run its course. The virus had to circumvent the globe. It had to happen. So all the things we did, we know were wrong now. The lockdowns, the masking, all that stuff didn't stop anything. It just prolonged it, Chip. It spread it out long. It made the pain actually longer and greater than it had to be. Now, it's the same thing with these banks. If they just protect them, the pain still has to come. And I just talked about the instance earlier in 2008. That's exactly what happened. The pain still had to happen, but you're just kicking the can down the road, because you just don't want to face it right now. It's going to happen. There's going to be ugliness. The faster we get through it, the easier it will be to recover from it, and people will get back to being on the prosperous side of it.
Well, David, obviously our clients have questions, listeners have questions, but we are out of time this week for Q&A. However, how many openings do we have for a 15-minute phone conference with one of our advisors this week?
We have 6 of those available, so 6 of those, take advantage. They do fill up quick.
402-369-7777. No charge, no obligation. Do you have a question about your retirement? Call and schedule a 15-minute phone conference with one of our licensed advisors. 402-369-7777. Up next, according to a Harvard study, what is the #1 challenge to a happy retirement? Stay tuned for the answer. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, I am going to ask you about that Harvard study about happiness in retirement. But before we get there, you sent me a story, and it was kind of a throwback story to CNBC back to September of 2008, a time period you referenced earlier in the show. And in your mind, there's a connection with what just happened with Silicon Valley Bank. What is that?
Well, I've mentioned it a couple times actually in the show today already. Is what happened with Bear Stearns and then Lehman following, and then they tried to calm the water, so to speak, by engineering a buyout. And just at that time, you also had basically Smith Barney got bought by Citi. Merrill Lynch got bought by Bank of America. All these forced transactions.
True. Yeah.
The Treasury Secretary kind of pushed in at the time. Paul, sorry, drawing a blank, but anyway, he
Is that Volcker?
No, it was not Volcker. It was anyway. But Paulson, sorry.
Okay.
Paulson, excuse me. But anyway, forced these transactions and to try and systemically calm the waters, and all it did was buy them a couple of months, and then the bottom fell out of the economy, and you have to let the damage happen. Just like the example I talked about, the coronavirus, you have to let things run their course, and history shows us this. And why? If you, I mean, I say it all the time. If you don't learn from history, you're doomed to repeat it, right? And why we don't learn from these things is crazy. So, but anyway, so there is danger on the horizon as I see it. That's my opinion, of course. And you can take action now and get protection. You can step out of harm's way if you want. Now, would you maybe give up some upside if another bazooka from the Fed of just free money was blasted out in some new stimulus package? Sure, you might give out. But understanding what people need to understand, Chip, is the risk-reward metric, right? Psychology tells us, Chip, if I make you 20% in 1 year, you're going to be happy, right? But if I lose you 20%, you're going to be 4 times more angry about that than the happiness you experience. It's a 4-to-1 ratio.
That
there.
applies in politics too. People remember much more what makes them angry, not what makes them happy, and
Right.
it motivates their votes.
And of course, that is now how all the ads are driven in the political world, et cetera, et cetera.
Right.
So I cannot stress enough, don't get angry, get proactive, get smart, and think about what matters to you. And we're not a fit for everybody. We do this show because we want to educate, but get with your guy or gal, your financial professional. And if you want a second opinion, we're here for you. But are you taking action? Are you being proactive? Are you comfortable with the way you're set up today for what you believe to be the near future? Now, I want to pivot to a story that Zero Hedge put out, and Zero Hedge is a kind of neat website. He tracks people and calls politicians out from all sides all the time.
That's the chart we were talking about before.
Absolutely. And so he put a chart out there. So we had some data points come out this week, Chip. So we had CPI still at 6%, right? That's inflation numbers. And then we had PPI actually come in negative 0.1. So PPI,
Producer Price
Index, came in better than expected. That was expected to go up, and it actually went negative, which is good. It means inflation is starting to get tamed maybe a little bit, unless we keep spending money, bailing banks out. But anyway, an inflation adjusted, in other words, if you calculate inflation plus your wages, we've just now had the 23rd consecutive month that the American worker has lost money. In other words, a negative earnings, inflation adjusted. No, that's never happened in history before. So President Biden has only been in office. He's been in office 25 months. He's only had 2 months that the American worker actually out-earned the inflation they were facing with the average wage increases they're getting. 23 consecutive months of negative wage growth.
So you're saying his first 2 months on the job were the positive wage growth months, and it's been all negative since
all
then.
negative since. So every month we're losing the battle. The American consumer is losing the battle under this administration because they're not taking action. Again, leave left and right out of it. This administration is just doing almost, as the article referenced, you would almost have to try to do worse than they're doing. You could have to, go strategically plan, go away on a retreat and come up with this master minion plan or the villain to how can I destroy the American economy to do this bad. It's really bad when you look at the data. And so again, there's consequences from elections, and we don't have another one for about 1.5 years, but we're going to start hearing the rhetoric on that soon. But man, take heed and take action yourself. That's the thing I want people to make sure. You can protect yourself if you take action. Don't just let the herd kind of dictate what you're doing.
David, I want to touch on one other item that you quickly referenced earlier in the show. You mentioned there are some additional proposals out there on Social Security reform. Here's a CNBC headline. Senators call for 2 changes to help encourage Social Security beneficiaries to claim retirement benefits later. Maybe you could start by clarifying for us, there's you can take it right at 62, or should I wait till 67 or till 70? Remind us of those and then tell us what's happening here with the legislation.
So if you're a widow or widower, you can start as early as 60, okay? But for most workers, if you qualified, if you've worked 10 years prior to age 62, if you've got 40 quarters of qualifying earnings, you're eligible to start drawing as early as 62 today. All right. Now, that is a discount. You're going to lose 30% of your benefit if you do it, okay? So it's not wise for most people. But it is available. But there's about 45% of people decide to do that. And so Congress is worried about people not having enough money in their 80s when they're older and retired. And the reason is they drew it early, so they left all that extra money on the table for all those years, a couple of decades, and it can be $100,000 and $120,000 difference, Chip, in their lifetime withdrawals. So it can be disastrous. Now, what we're seeing now is we're seeing a couple different competing pieces of potential legislation getting worked up in Congress, and there's bipartisan support on both. One is they're going to actually make some actuarial changes, which is I think you have to do. We've talked about it. We've only done it once. Push out the age with which you could draw. 62 is too early today. Maybe the early withdrawal should be 65, and full retirement age should be maybe 70, and then maybe get your max benefit out to 73, where RMD age is today, right? We just did those RMD calculations based on actual data. Why not make the adjustments for Social Security? That alone would solve Social Security's problems just about by itself. There'll be still a small gap simply because we've talked about before, my generation, Gen X, is less than half the size of your generation, the baby boomers. But behind me is a generation bigger than both of ours, the millennials. And so there will be wages in here to go back in the coffers and fill the coffers, but we're going to have about a 2-decade where we just need a little help, and that can be solved pretty easily, and it should have been solved while interest rates were at 0, by the way. They could have took out some long bonds. But anyway, so there's bipartisan support to not only help actually fix it, but also to change the language and the communication from Social Security, because Social Security, we talked about in a previous show, gets the wrong information quite often, unfortunately, to the recipient, and they're not really supposed to give them advice, and they don't even know what they're talking about half the time, sadly. And again, I'm not trying to bash anybody that works at Social Security system here locally, et cetera, but this is stuff, you only get one shot at this. You need to get it right, and that's what the class Sean will be teaching will cover.
And would you also clarify for us, you like to say there's a difference between maximize and optimize. What is that difference?
So when I say maximize, how do you get the most likely maximum dollar benefit from the government paid out to you in your life expectancy?
Which is
right?
what most people, that's the default setting. How can I maximize?
Right. It's not always the best decision to optimize how much of that you keep, right? So to optimize it, we need to take tax into the calculation. Here in the state of Nebraska, you still pay tax on Social Security. Now, that looks like it's going to go away.
Being phased out, but
Right.
you are still paying.
You are still paying at the moment, but Pillen is trying to rip that Band-Aid off pretty quick, Governor Pillen, and that would help. But so how much you pay in both Fed and state tax on those benefits if you're paying state tax? And again, we're one of only, I think, 6 left that tax it. Not a lot of people tax Social Security, but on the state level. But do you understand how it gets taxed? And if you have other taxable income, you up to 85% can tax. We can change that by proactively planning. And I don't want time today to go into that. But again, these are the things we'll cover in the footprint class, Social Security blueprint. Excuse me, not footprint.
In the time we have left, David, let's end on an upbeat note. Well, it can be an upbeat note if you manage it the right way. CNBC headline: An 85-year Harvard study on happiness found the #1 retirement challenge that no one talks about. David, it's not financial, it's maintaining social connections.
Yes. So a lot of people.
Is this something you've seen in your career?
Oh, absolutely. And we talk about the go-go years being very real, right? But you need to be, if you're just isolated, right? So the old adage, I mean, when I started, 24 years or whatever ago it was, the adage was, hey, they'd come in, they work for GE for 40 years and they retired, they got a gold Seiko watch and then they got a pension and they went onto the rocking chair and maybe hung out with the grandkids. And it was a very different vision of retirement. And frankly, in today's society, with all the things we have and the connections and social media, most people, that's not what they dream of for retirement, right? So I always say you're retired when you're doing what you want to do when you want to do it. So
Okay.
I am effectively retired. I make money doing this and what have you, but I don't have to work. I'm work-life optional. I told a client this week, she was like, "Can I quit?" It's like, yeah, just we ran some number. You're done if you want. No, I don't want to quit. But I just need to know. Thank you.
Okay. Yeah.
And I always love to tell people when you're work-life optional, right? Now, the happiness factor here is what's really important. And the Harvard study says is a lot of people lose meaning when they stop working, right? It's what provides us drive. We want to accomplish goals at work, projects, and engineers are really big on this. When we help retire engineers or project managers at big companies, they're like, "Hey, Dave, I'm ready to retire, but, well, no, thanks for letting me know I can, but I got to see this project through." So it's like 9 months out or 18 months out. Just had this talk yesterday with a client that I'm trying to get retired because for tax reasons, this person's hurting themselves working. But anyway, that's a whole nother story. But he's got to finish up this one project that he just feels compassion to do. So when you retire, Chip, the baseline is you need to go find your social happiness. Volunteer somewhere. be in a club, church or synagogue, volunteer, get engaged. Don't just lose sight of your coworkers. Go to the breakfast in the morning. Maybe mentor a younger worker at your old company. There's so many ways you can stay engaged, and that's what this study is referencing. You've got to have meaning and purpose in your life, or you're going to get, unfortunately, maybe some depression. So let's end on a happy note. Let's help you find out if you're work-life optional.
Let us help you get into that position of being work-life optional. We've got the inflation guide. We're offering a 15-minute phone conference with one of our advisors if you want that. Take the plunge, get the report card, the comprehensive review of your situation. We got the Social Security Workshop, March 22nd, 6:30 p.m., right here at the Midwest Learning Center. The Smart Insurance Workshop, that's March 28th, 10 in the morning, 6:30 at night. All of it, 402-369-7777. 402-369-7777. David, bring us home.
Happy birthday, Drew, my oldest child. Happy 27th birthday. Folks, have a blessed and happy week.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.